You've probably noticed all the buzz lately about the best cryptocurrencies to buy during this bull market. For instance, if you'd bought Bitcoin earlier this year, you'd be up 140%. Dogecoin skyrocketed by 350%, and Peanut the Squirrel coin somehow shot up 1,500% in just a week. But seeing these wild success stories got me thinking, is there a way to figure out which cryptocurrencies have the highest potential returns? How much profit could you have made if you bought and held on to them? Can we identify the ones that are likely to crash and burn? And finally, is it possible to use this knowledge to make smarter choices and save or earn a lot of money? Let's dive into something that could potentially be a game changer. Back in 2012, an analysis revealed patterns that gave people the best chance of making money. The findings are so compelling that we can't ignore them. It might even be one of the biggest wealth transfers in history. But here's the reality. We're facing a major money problem. Even though inflation has cooled down to nearly 2% and the stock market is breaking records, the average American is getting poorer every year. Think about it. The S&P 500 has delivered an impressive 10% annualized return since the 1920s. Yet, during that same period, we've been printing 10% more money every year, effectively diluting wealth. This is why many people see cryptocurrency, especially Bitcoin, as a solution. Bitcoin has consistently outpaced the growth of the money supply, making it one of the best performing asset classes over time. Could this be the answer we're looking for? Let's explore. Bitcoin's value has grown massively since it started in 2009, becoming the best performing asset, with a rise of over 20,000% since 2015, much higher than the S&P 500. There will only ever be 21 million Bitcoins, which makes it unique. However, its price can drop a lot, sometimes 50% to 90%, before bouncing back. So how can you use this to make money? Let's break it down. Here's the truth about cryptocurrency. While some people get lucky and make huge profits, most won't. There are over 15,000 cryptocurrencies, but only 38% of them are still active today, and this means the chance of a coin surviving long-term is only 1 in 3, similar to the stock market's failure rate. Studies from Vanguard show that lump sum investing outperforms dollar cost averaging 69% of the time. The same pattern holds true for Bitcoin, where research from data analysis firm Bitwise Asset Management shows lump sum investing beat dollar cost averaging 66% of the time since 2013. While dollar cost averaging can help reduce losses in bear markets, such as in 2018 and 2022, lump sum investing significantly outperformed during bull markets like 2017, where it returned over 700%. So if you're holding for over a year, investing all at once is generally more beneficial. When it comes to investing in cryptocurrencies, the question arises, is it better to invest all at once or spread it out over time? Studies show that lump sum investing often outperforms dollar cost averaging. Vanguard reports that lump sum investing beats dollar cost averaging 69% of the time. And the same is true for Bitcoin, where it outperformed 66% of the time since 2013. While dollar cost averaging helps reduce losses during bear markets, lump sum investing can deliver big gains during bull runs. For Bitcoin, investing all at once is generally better if you plan to hold for over a year. However, this doesn't apply to all cryptocurrencies, especially those with high volatility. Also, many investors neglect basic steps to protect their data, which is key to securing their wealth. Bitcoin has remained the top cryptocurrency for the past 10 years, even as other coins have come and gone. This raises the question, is there a strategy for consistently succeeding in crypto? One example is the Top 10 Crypto Index Fund, which has tracked the top 10 cryptocurrencies annually since 2018. Each year, they invest $1,000 equally across the top 10 coins, $100 per coin, and track how their performance compares to the overall market. As of November 1st, the top 10 crypto portfolio is up just 3% this year, despite Bitcoin performing well, while the overall crypto market has grown by 6%. This shows that even a diversified approach with top coins doesn't always outperform the broader market. Since early November, the crypto market has surged, turning earlier losses into gains, which will be reflected in the December update. If you had invested $1,000 annually in the top 10 cryptos since 2018, your portfolio would be worth $20,829 by November 1st, far higher than the S&P 500's $1,624, showing that crypto has historically offered better long-term returns. Past performance doesn't guarantee future results, and timing is crucial. For example, in 2017, a crypto portfolio saw an 84% loss, peaking at 94%. In 2019, while the S&P 500 gained 29%, crypto only rose 1.74%, with most coins losing value. The key takeaway is that while crypto can yield higher returns, it's also highly volatile and risky, especially depending on when you invest. Crypto's major gains only started in 2020 and 2021, but those who stuck with it through tough years saw their earlier losses overshadowed. However, the risk of significant losses remains. Bitcoin's recent surge is mainly due to reduced regulatory pressure and optimism around a new proposal. Senator Cynthia Lumis's plan suggests the U.S. could become the largest Bitcoin holder, owning 5% of the total supply, similar to gold reserves. With Republicans in control and Trump endorsing Bitcoin, there's growing hope this proposal could gain traction. Some Democrats also support Bitcoin as a potential Federal Reserve asset, seeing it as valuable for the U.S. financial strategy. Countries like El Salvador and companies like Tesla have benefited from holding Bitcoin. If the U.S. also accumulates significant Bitcoin, it could strengthen its financial dominance, similar to the U.S. dollar's role as the reserve currency. Bitcoin is increasingly seen as a global store of value. With growing optimism about the Trump administration embracing crypto, some believe the U.S. could become the global hub for crypto innovation. This has sparked belief that the crypto market is just beginning, with huge potential for future price growth, often called the greatest transfer of wealth in history. Cryptocurrencies, like penny stocks, can be risky if you're not careful. Here are some tips to protect your investments. 1. Overconfidence. Many investors, after success, take on more risks thinking it's skill, not luck, which often leads to losses. 2. Emotions, greed, fear, and regret can hurt your performance. Managing emotions is key to staying steady and making smart choices. 3. Risk-taking. If you have less money, you might take riskier bets to catch up, but these often result in big losses. Or quick profits. Be wary of promises of easy gains. The most successful crypto investors are those who buy and hold, avoiding frequent trading and speculation. In short, focus on long-term steady strategies and don't let emotions drive your decisions. Most cryptocurrencies are a gamble like the Wild West, and you could lose a lot of money. Even with Bitcoin, predictions are just guesses. While Bitcoin's future looks promising, it might not hit $1 million anytime soon. Only invest what you can afford to lose. This isn't to scare you, but to remind you that crypto is risky. Understand the risks to protect your investments and avoid unrealistic expectations. The market is unpredictable, so be cautious before planning big profits. It's wise to take profits if you're heavily invested in something volatile or have made life-changing gains. Do your own research and get different perspectives before deciding. For example, allocating just 1% of your portfolio to Bitcoin can boost returns with low volatility, similar to bonds. I'm not against Bitcoin, I just want you to invest safely and for the long term. Only invest what you can afford to lose, and be patient. Thanks for watching. Don't forget to like and subscribe.